Year to date, the stock market has looked very strong unless you are a shareholder of Intel or Boeing, so you would be very happy overall. But what we do note is over the last month, the semiconductor industry in particular has taken a hit right across the board. And today we want to understand if any of these big names are companies we should be adding. Now, we do understand that over the longer term, in fact, if we just look specifically over the last 20 years, the blue line, which depicts the revenue, we can see pretty much for this industry, it is moving in the right direction. Now, we do get some bumps, as we know this is a fairly cyclical industry, but when we do zoom out, we can in fact see some very nice progress. In fact, just over the last year, we see this revenue up nearly 20%. We also note that if we think about the semiconductors and the massive role they have to play, the global artificial intelligence market is one that is expected to grow at a very rapid rate over the next 6 years, with a compounded annual growth rate of around 37%. We've seen other articles from Bloomberg where they believe it will be inching higher to around the 42% level. Now, today we're going to take a look at 10 of the biggest names in the semiconductor space. We'll talk about their historical performance very briefly, as well as cover the expectations moving forwards, how they've performed over the last 4 quarters, and more importantly, we want to run through each one and see whether or not we believe them to be a buy, what our margin of safety is. We can talk a little bit about how we value them and the upside that Wall Street in particular see to understand whether or not we should be buying some very big names in this space for massive growth in the future. Now, we have to start off with the king of this space, which is NVIDIA, and as we have regularly seen on this channel, Wall Street do give this a strong buy rating, although we can see both Seeking Alpha as well as Quant giving this a hold. Now, it is trading in the upper end of the 52-week range, although we do note it is a little bit away from its 52-week high of $141. It also pays a yield fairly trivial, 0.03%, and has a forward PE just above 41. For those that want to know, S&P right now trading around 23. We also note over the last 12 months, it is up 161%. Over the last 10 years, phenomenal performance, up 28,481. And even though that doesn't include dividends reinvested, we can still see an absolutely phenomenal performance, probably the best if you have had this in your portfolio. Now, moving forward, they are anticipating the growth to continue. In fact, over the next 4 quarters, double-digit growth to the EPS year on year. And if we go back over the last 4 quarters, 100% track record, indicating that NVIDIA have outperformed management targets, which is always a good sign to see, and that is the expectation as well moving forwards. Now, as we already showed you just a few seconds ago, our intrinsic value of this company sits at $140. Now, we have used the DCF model to get to our expected fair value, and just to run this through very briefly for those that maybe this is new to, we typically have our free cash flow per share year on year, the growth on a year on year basis. Now, for NVIDIA, over the last 5 years, it has grown at 135% year on year. Over the last 10 years, 94%, and we have gone moving forwards at a 30% range. As always, we do like to use a low, medium, and high rate, and when we use that 30% rate moving forwards with the discount rate, we ultimately end up with the present value of future free cash flows and terminal value for each year. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can clearly see here, this will give $140, which ultimately means 21% upside. Now, if you believe that is way too high and you want to be more conservative, well, just for transparency, the 25% rate would give $100. That implies a downside of 13%. For those that believe it should be a lot higher, well, 35%, 193, and that indicates 66% upside. Now, previous in-depth dives, we have run through Bloomberg, their expectation for around 42% over the next 10 years. And what we can ultimately see, if they do hit that, our intrinsic value is 297, indicating 156% upside, more than double the current trading value. Now, remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below. Whether it's for NVIDIA or whether or not you want to use these numbers, you can go ahead and do so. But we are going to take through the medium rate today of 30%. And as we said, intrinsic value $140. And with our margin of safety on this channel, which we run through every single company, we execute on the 10% level if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for NVIDIA will buy up to $126, then we keep going till it's near the current trading price. And in today's episode, you are getting a 20% MOS if it hits the 112 point. Right now, though, we see it sitting between 15 to 20%, with Wall Street giving this a $152 price target, where in fact they see 31% over the next 12 months. As always, do give us your thoughts about these 10 stocks as we run through them in today's episode. Now, we also want to let you know we have released our latest free weekly article. We normally drop one to your inbox every single Monday. You can see the latest one. We have run through 3 stocks we're looking to buy in October, and with each one we do give a very brief market update, what's happened over the last few days, and you can click on that pinned comment below, sign up and read these articles straight away. On top of that, we have released our 36 undervalued dividend stocks that we believe for the month of October, where we give a lot of detail on each one of these companies and discuss whether or not they sit within our own portfolio. And finally, you are also able to grab 22 dividend stocks, which Wall Street at this point in time believe have the most upside. As we can see, number 1 right now, Micron Technology. As always, you can click below, sign up and read straight away. The next stock we're moving on to is Broadcom, where we get another strong buy from Wall Street, a buy from Seeking Alpha and a hold from Quant. This one trades at the upper end of the 52-week range with a yield that is higher than NVIDIA, 1.27%, a forward P that is also lower at 34.5, but hasn't formed as strongly, still very respectfully up 101% over the last year, and massively outperformed the S&P, similar to NVIDIA, up 2,237% over the last 10 years. We also note moving forwards they are anticipating the next 4 quarters to be double-digit EPS growth, while also keeping up that trend that we have seen with NVIDIA of outperforming analyst targets just over the last 4 quarters. Now, in terms of the valuation, we can see here a $165 mark, and ultimately we also ran that through the DCF model, where we have the free cash flow year on year. Their average growth was also very impressive at 48%, so we've gone for 15%, which as we can see we have a low, medium and high, 10, 15, 20. Based on that 15%, it does look like an intrinsic value of 165, which ultimately gives no upside, essentially telling us that it is trading at its fair value. Again, for transparency, we will just show it for this one and then moving forward stick to the one we use. But at 10%, 112, downside of 32%, at the 20% level point, essentially 239.54, which gives 44% upside. We are going to be a little bit more conservative, and at that 15% point for Broadcom, what we essentially are saying is there is no margin of safety, but if you are looking for a minimal margin of safety at 5%, we do believe a buy at 157, at the 10 percentage point around 149, around 15% around 140. As always though, some people will believe companies like Broadcom, like NVIDIA, do deserve to be essentially a buy around their fair value or even paying a premium. We just want to highlight that right now for Broadcom, we do believe it is trading at its fair value. However, we do notice that Wall Street have upside of 20%. They give a price target of $199. As always though, do give us your thoughts. Maybe Broadcom is one you are also looking to buy now, or you are waiting a little bit for a decent level in terms of margin of safety. We then move on to Taiwan Semiconductors, where we get a double strong buy from Wall Street this time and Quant, with a buy from Seeking Alpha, again similarly trading at the upper end of the 52-week range, with a yield of around 1.28%, a forward PE lower than both NVIDIA and Broadcom at 26, and over the last year, very comparable performance to Broadcom, up 96%. Over the last 10 years, again, significantly outperforming the S&P, up 793%. They also follow a very similar trend, as we already saw, double-digit increase expected EPS-wise year on year over the next 4 quarters, and over the previous 4, they have also outperformed analyst targets. So far, these first 3 looking very strong. In terms of our intrinsic value, we have $204, current price around $172. So for TSM, we do in fact see a nice margin of safety. At 10%, a buy at 183, at 15%, pretty much around the current trading price, and as we saw, a double strong buy rating, which is quite rare when we do look at Quant, where they don't typically offer a buy rating, let alone a strong buy. Now, if you are looking for 20%, we can see a buy around 163, but in today's episode, 15% MOS, with Wall Street indicating 19% upside, a $205 forecasted target over the next year. Continuing on, we have ASML with a double buy rating and a hold from Quant. This one is trading in the mid to lower end of the 52-week range, with a yield of 0.8% and a forward P around 39.6. Now, over the last year, up 41%. Over the last 10 years, up 810. So again, significantly outperforming the S&P, as has been the theme today. Now, we do know very strong growth anticipated over the next 4 quarters, as well as outperforming over the last 4, giving them that 100% track record. And when we do take a look at the intrinsic value, $1,152 is essentially the intrinsic value we have calculated, and that does give quite a substantial margin of safety. At 10% a buy over $1,000, at 20% a buy at $922, and at the 30% point, it isn't quite there yet, not too far off it. So in today's episode, we see between a 25 to 30% MOS for what we do deem to be a very strong company in this industry. Wall Street, as we can see, price target 1173 over the next year with upside of 42%. They do believe this is one you should strongly consider, especially if you don't have any exposure to this industry. We then move on to Advanced Micro Devices with another double buy and hold from Quant. This one's similar to ASML, trading in the mid to lower end of the 52-week range. This one doesn't currently pay a dividend and has a forward PE of 47.2. Good performance over the last 12 months, up 55%. Over the last 10 years, massive outperformance, up 4,734. And when we do look at it over the next 4 quarters, again, double-digit EPS growth expected, and also outperformed, or at a bare minimum, in line with management targets. So again, very good signs to see. In terms of our valuation, well, first thing to note, our intrinsic value at 189 isn't dissimilar from Wall Street and their price target of 188, where they see 19% upside over the next 12 months. And in terms of margin of safety, well, 10% a buy at 170, at 15% a buy at 161, and not quite there at that 20%, so leaning more towards a 15% MOS with 19% upside for AMD in today's episode. We then move on to Lam Research, where we have a double buy rating and a hold from Quant. This one trades again similar to the previous two at the mid to low end of the 52-week range, forward yield of 1.15% and a forward PE of around 22.3. Over the last year, we're up around 26%, not too far off the S&P. Over the last 10 years, however, massive outperformance, up more than 1,148%. We also like to see this double-digit EPS growth, which has been a real trend that we are seeing in this industry from the companies we have taken a look, as well as outperforming over the last 4 quarters, which is a very good sign to note. But do remember that the past performance doesn't have any indication on how they could perform in the future. We do also see that our intrinsic value of $1,088 isn't far off Wall Street's 1072, where they have 35% upside over the next year. In terms of margin of safety, well, 10% a buy at 979, and then we keep going, a nice MOS in today's episode. At the 30%, it isn't quite there yet, and what we in fact see, it is leaning more towards a 25% margin of safety with a lot of upside according to Wall Street. So similar to pretty much the majority of those that we have covered so far, these are ones that you should have some consideration for in terms of your overall portfolio if you do believe it does fit your investment thesis. And for any of these, we can do a deeper dive as well. We then move on to Micron Technology with a strong buy from Wall Street and a double buy from seeking out from Quant. Again, trading in the mid to low end of the 52-week range, a smaller yield of 0.46% and a forward P of 11.3. Now, over the last year, up 48%. Over the last 10 years, it is up 257%. It has outperformed the S&P, but is one of the lower performers from those that we have just recently reviewed. In terms of moving forwards, well, we do see some very large growth, triple digit in fact expected over the next few quarters, and we can also see some very good performance having a 100% track record. In terms of Micron Technology, well, our intrinsic value at 138 does show us that it has a nice margin of safety. As we can clearly see in today's episode, it is pretty much around a 30%, just a few dollars shy. So that is a good sign again for companies if you do want to consider them, if they do fit the bill in your overall thesis. And Wall Street do like this company a lot, upside of 51%. Their price target right now is $149. Don't forget, do give us your thoughts. A lot of these companies, I know the community have already positions. Interesting to hear whether or not you have been adding over the last few days. We then move on to Supermicro Computer that just recently had their 10-for-1 stock split. We have a buy rating from Wall Street, a double hold from Quant and Seeking Alpha, trading right there towards the lower end of the 52-week range. Similar to AMD, no dividend paid, forward P around 12.2, and over the last year, respectable performance, up 40%. Over the last 10 years, following a similar trend, very, very strong, up 1,675. We also note moving forwards, double-digit increases anticipated. In fact, next quarter, they're anticipating 114%. The first one to have a miss, which was their more recent quarter, Q4, and a substantial at 19 cents, although we can see 75% track record as they did outperform in the previous three. In terms of the valuation, well, our intrinsic value at $53 is lower than Wall Street. They see a lot of upside, in fact 60%, their price target of $64. This is one that we actually reviewed just a few days ago, so if you want an in-depth deep dive as to the issues surrounding this company, do go check that out. In terms of margin of safety, well, 10% we see a buy at $47.50, at 15% around 45, at 20% a buy at 42.21, and we can see in today's episode you're pretty much getting near a 25% MOS. As we said already, massive upside from Wall Street from what they see at around 60%. We then move on to Qualcomm, where we have another double buy and hold from Quant. This one is similarly trading in the mid to low end of the 52-week range, one of the high yielders today at just over 2%, and a reasonable forward PE around 16.5. Over the last year, very impressive, up 50%. Over the last 10 years, it has outperformed, although marginally the S&P up 139%. And always good to see here, very nice EPS growth anticipated over the next 4 quarters and outperformed, so a 100% track record, always great to see. We notice our intrinsic value of 217, very marginally lower than Wall Street 221. They see upside of 34%. And when we do look at that margin of safety, 10% a buy at 195, 20% a buy at 173, and we can see in today's episode, not quite at the 25% level just yet. Qualcomm today then sitting somewhere between 20 to 25 with 34% upside from Wall Street and their expectations. We then finally get to Intel, in fact the first one where we get a triple hold rating right across the board. This one is trading right there towards its 52-week lows, recently cut their dividend, and we can see a fairly high forward PE as they have been struggling with those earnings. Over the last 12 months, well, down 36%. Over the last 10 years, the first one to be down, and that is negative 26%. In terms of their earnings, well, they do have a very large mismatch over the next few quarters, and as we can see, they did have a notable miss in Q2 2024, one that we did cover, so if you want more information on that, do go check out our in-depth dive on Intel. In terms of the intrinsic value though, we have a price here of $28.20, a little bit higher than Wall Street, their target $26, they see upside of 16%. And when we do look at margin of safety, well, 10% a buy at $25, at the 20% around $22.56. So pretty much for Intel, we see a 20% margin of safety. Maybe not enough for those that do want to consider this company. There are a lot of issues surrounding it, but again, will depend whether or not, as an investor, you do believe they can turn this around. And finally, 16%, as we said, from Wall Street over the next year. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to sign up to the free weekly newsletter below. And as always, come and join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.